Ed Cofrancesco. He's of International Assets Advisory. And Ed, I mean, this record August that we've been talking about, the S&P coming into the week with 5 straight weeks of gains. What are your thoughts just about the broader market at these levels and the big run-up that we've seen in stocks?
Well, here at IAA, we expected the market to rebound. We expected to be 2 steps forward, 1 step back, 3 steps forward, 2 steps back, but to slowly but surely rebound to where it was pre-COVID. Now, in this last few weeks, we've started to build momentum, as you mentioned, Sean, and now it seems like we haven't taken a step or 2 back that we had in the past in prior months. We still expect that to happen. There's a lot of news, whether it's geopolitical, COVID, civil unrest here in the country, so many other factors that can still bring us down. But overall, in the macro viewpoint, we're extremely optimistic. Despite everything that we've just been through and are still going through as a nation, our markets have shown amazing resiliency. We've seen the savings rate go up in the country, and we believe that by the end of 2021, that we're going to be looking at a Dow 35,000. We think there's another 15 to 20% by that time in the S&P and the NASDAQ. So overall, we're very bullish here at IAA.
So Ed, how do you play that when you have estimates like the Dow headed towards 35,000 within the next year or so, 15 to 20% gains in the S&P and the NASDAQ? Are you still betting on the names that have been working in this rally, a lot of those big tech names, or are you finding value elsewhere?
Well, we're still a big fan of the big tech. Obviously, big tech is a large part of how we as an economy have been able to get by as we have. I mean, obviously, huge parts of the economy are devastated by COVID, but without big tech, we wouldn't have had all, as we're having this conference right now, we were all working remotely and so forth in so many industries that we wouldn't have been able to do. So we still love big tech. We think Tesla is, a couple of years ago, I guess we were really wrong in that call. We were a little bit bearish on Tesla, and Tesla's only gone one way since then. So we've decided to get on the Tesla bandwagon in the not too distant past, and we think Tesla can continue to rise. We think that they're going to continue to have some innovation, even though we expect other competitors to enter that space. In a few days, we're going to be having Lucid coming out in the New York. I don't know how exactly they're doing the New York Auto Show on September 8th, but Lucid's going to come out, and they have a car that's got a 500-mile range. We still like Apple and Tesla post-split. We think they're going to do phenomenal. We like the big pharma stocks because we think one or more of them are going to deliver what we need to eventually put COVID in our rearview mirror. And we still like, I think, about 4 or 5 months ago when I was on with you guys, we said we loved single-family home builders. And we said that we felt that this was going to start momentum to the burbs for a lot of people, that obviously our city cores, our downtown areas got hit a lot harder by COVID than the outlying districts, as New York City is an example. And a lot of companies were finding that we could work more remotely. And as a result, we said we thought there was going to continue to be a trend in suburbanization. We also said that we thought that a lot of the millennials, so people didn't think we're going to move to the suburbs, we're already starting to move to the suburbs pre-COVID. And so all these trends that we talked about 4 or 5 months ago have pretty much played out, and we think are going to continue to play out for the next 18 months.
Hey, Ed, Rick Newman here. Weakening dollar, some people think that will drain money out of the U.S. stock market. What do you think about that?
So, Rick, we think a weakening dollar is going to happen. We think we're going to have inflation, but we think inflation will also lift the value of some core assets as it has in the past. So if you wanted to hedge your portfolio, whether it's with gold, which has always been a hedge against inflation, or we also recommend the Swiss franc. I mean, at the end of the day, the Swiss franc, if you've looked at what the Swiss franc has done in the macro terms against the US dollar for the last 20 years, it's only been one way. And so obviously, if you hold Swiss franc, you're going to pay negative interest rate. I know that's something a lot of American investors aren't used to, actually paying money to hold a currency. But the Japanese investors and Swiss investors have been paying money to hold cash balances for a while, but it's only a minor amount. And so we certainly think an allocation to gold and an allocation to Swiss franc is very worth your consideration.
What about looking into emerging markets? We've heard a lot of guests come on our shows to talk about how that would be sort of a good play on the back of a weaker dollar. I mean, how are you treating EMs right now?
Well, Kiko, the name of the firm is International Assets. We were founded on international investing. We were investing in emerging markets 30, 40 years ago before people knew what they were. And so we're still fans of them. Even when they've had a bad run, we still felt that you should have an allocation. We think a lot of emerging market economies, did not get hit nearly as hard as the developing world in terms of COVID. So we're big fans in emerging market. We think a lot of cases, unless you have advisors that are specialized in that field, your best bet is these ETFs. As one of your other guests mentioned today, we love ETFs or that type of broad-based investing.
Yeah, and just quickly, same kind of question about healthcare, that it's such a big business, right? I understand the allure, but how does a retail investor best play there?
Well, Andy, we're fans of pharma. We're pretty neutral on healthcare. If you're meaning healthcare like Aetna, United, et cetera, we think that they work on a lot smaller margins than people realize. And with a possible change in administration, we don't know what that means for them. So we're pretty market neutral on healthcare right now.